This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Mike's picture that says looking for the downloads. Now, Eric, let's jump into this chart on crude oil. What do you see and how did the EIA inventories come in?
EIA printed a build of 3 million barrels, but that was really flat after pilfering 3 million barrels out of the SPR. So, you steal from one pocket, pay off the other one, I guess. We're still drawing from the SPR, and we're drawing from the SPR at an increasing rate. It was 1 million barrels 2 weeks ago, then it was 2 million barrels last week. Now it's 3 million barrels this week, at a time when they promised they'd be refilling it. Cushing, Oklahoma, building 397,000 barrels, but the big drawdowns were in finished products. So even though we've got a build on the board with crude oil showing a nice fat 3 million barrel build, first of all, it's not really a build because it's offset by the SPR. But then when you look at finished products, the overall net petroleum products is a massive drawdown, with gasoline drawing down 3.2 million barrels and distillates drawing down 4.2 million barrels. U.S. production held steady at 12.3 million barrels, unchanged from last week, and that figure is a plateau. That's the highest number that we've seen post-COVID pandemic. Tape action, prices dipped a little bit after inventory, but then recovered. And we're really at the point now where if this was just a dead cat bounce, it's time for it to roll over. So as we approach the 13-day moving average, then the 100-day moving average above that at 76.68, those are the major resistances. If we get above those, above 76.68, we could see a new trend here. But so far, we've seen so many disappointments in the crude oil market, it's time to watch most closely for the possibility of prices rolling back over to the downside.
Yeah, Eric, when looking at this crude oil chart, what I did was I highlighted the high volume node consolidation area, which is essentially the trade range that has dominated the oil markets since October of last year. And what we have is a scenario where we've now once again obviously broke violently through this trade range. And now we've seen the reflexive snapback rally. And just like you were suggesting, it's a very important moment in my mind in terms of what happens next. If the bulls are going to in any way neutralize the sell cycle, they're going to need to get this oil trading back in the trade range. So we want to see prices back in the mid 70s toward 80 and really just calm everything down. But a failure at this level, I'll have to agree with you, is a vulnerable moment. And if we roll over off this level, and especially if we see any return back below $70, that would keep the sell window open and leave vulnerability to even see $60, especially if we see economic deterioration. Let's see what happens here. Very important pivot here on crude oil. All right, let's move on to equities. And Nick, I want to start off here and talk in this S&P 500. First of all, what levels are you watching?
Spot right now, Patrick, is 41.35 approximately. There's a call wall above at 4,200, which hasn't changed. Put wall below at 3,900. The implied move for next Friday's May 19th OPEX is plus or minus 65 points. So the upper expected move is 4,200, right where that call wall is. No coincidence there. And the lower expected move is around 40.70. We have key resistance above at 41.50, which we tapped above and then pulled right back below that. Then we obviously tested out the 4,000 key support area, interestingly enough, and bounced off that again. So we're in this trade range right now. Again, key resistance above 41.50 and then 4,200. Key support below is 4,100, 40.50, then 4,000. We keep on bouncing in this range over the last month or so. We've sat between 40.75 and 41.75 basically the entire month and have not moved at all. So very interesting price action here. If we do end up breaking above that 4150 area and pushing toward 4200 into next Friday's OPEX, it's possible we see a peak above it, but I'm not sure how much more steam ahead we have, given that the market breadth is pretty weak right now. We're seeing a few names like Google and Amazon and Apple carrying the market higher, whereas everything else is stagnating, so to speak. But right now, again, I think short term, perhaps a little bit more bullish activity, but medium to longer term, I'm quite bearish.
Yeah, it's interesting you say that, because for me, the S&P 500, if we look on page 4, the S&P 500 has that 4,200 overhead resistance. And even a week or two ago, I was giving the bulls the benefit of the doubt, because we were going into an FOMC, we were getting jobs numbers, we now got the inflation prints. There was all in a news that arguably, if not bearish, could have given the kind of green light for the bulls to break the market out to a higher high and punch 4,300 or higher on the market. But the market really comes across to me as incredibly exhausted. While the bulls have not dropped the ball here, I mean, at this stage, it's still in bull trend and dips are being bought. But overall, it seems like they have no momentum, and inevitably that is just going to fall under its own weight. What we'll be watching for is any legitimate breakdown below 4,100. Conveniently, the 4,000 level is where the 200-day moving average, which I've drawn on here, is there, and it's also where the Fibonacci retracement zone is in that March to April rally. And so, if we see any breakdown below 4,100, the major support will come near 4,000. But if we start seeing a distribution cycle like that, we might end up seeing the start of some sort of 3 to 6 week kind of correction into the summer. I don't think it has to be the big ominous market drop, but the bulls really have to show that they've got some fuel left in the tank and punch this resistance level to go higher. Failure here, I think we might end up getting into a bit of a sell cycle. Anyway, let's move on to the NASDAQ, because this is where certainly the relative strength has been as we break to a little bit of a higher high here. What are the levels you're watching on the Qs?
Right, you are, Patrick. I mean, we've seen the NASDAQ remain very strong regardless of what the S&P or the Russell have been doing. So right now, spot is 325. Call wall is actually right where we are right now, 325, and a put wall is below at 315. The implied move for next Friday, May 19th OPEX, is plus minus 6 points. Upper expected move is 331, and the lower expected move is 319 approximately. Key resistance above right now is at 335, and key support below is at 310. And as I mentioned prior, we have Google, Apple, Amazon primarily driving the market higher, as well as Microsoft. So we have 4 key names, along with Meta perhaps, 4 to 5 key names driving the market higher in the Qs. But the S&P is not following suit. It's staying in a choppy range. So a decent strategy to maybe look at perhaps is remaining long big tech and short cautiously the broad market, because if we do run higher, chances are we're going to see these big names run higher as well. I doubt that we run much higher without seeing Apple, Google, Meta, Microsoft, etc. run higher as well, right? So right now, I'm short-term bullish, but I'm medium to long-term much more bearish. And I do like Microsoft and Google, as I said previously in other sessions. So I'm bullish on those names. But again, you got to be cautious here, because, as we've seen, the market can turn around very fast, and that's where it can surprise a lot of people.
Yeah, what's interesting is that we have to talk about that market breadth continuing to be really weak. So I have on page 6 that Russell 2000 chart, and we see that even that bounce off that support line, which is just a stone's throw away from its 52-week lows, still showing a predominant weakness in the small caps. But when you were talking about all these mega cap FANG stocks continuing to be the leaders, what's interesting is while the S&P 500's right above at along that 4,200 level where all that resistance is. What's interesting is you take something like the S&P 500 equal weight index, which doesn't have all these big, huge market cap behemoths as dominant, is 8% off of its February and March highs, and is still 2 or 3% off of even its April highs. We're seeing that the broader S&P 500 is simply already rolling over. This is really going to be just a big question of whether or not these FANG stocks can keep everything afloat. On page 7, I have the breadth of the market by just looking at the percentage of stocks that are trading above their 50-day moving averages. And what you see is that we remain and have been through April going here into May below the 50% line. We're right now at 45% of stocks above their 50-day moving average. Just continues to show that there is no breadth in this market and it's getting very heavy. And so I'm becoming incredibly cautious here. Nonetheless, Nick, on page 8, we have that VIX. And what's interesting is in spite of the market being heavy, it's also very quiet and volatility is somewhat still compressed. We're at the bottom in this range. What are you thinking here?
Yeah, so as I said in the past, this the key level is 20, I would say, on the VIX. If we break above that and hold above, we could push higher. But again, as I said, for the past few weeks, this 0DTE option activity is suppressing the volatility on the VIX overall. And yesterday was a great case in point. We opened at 41.55 on SPX. We dropped down to 4,000 basically, and the VIX was relatively flat, right? Like a 55-point drop intraday, and the VIX is flat. So that tells you all you need to know right now about the VIX. It's not as meaningful as it once was, perhaps. And so a better gauge might be to look at the option activity on the 0DTEs, which unfortunately is guiding the market in this tight range each and every day. Like what I've been noticing is that if you look at the charts over the past month, the one-day chart, look at the market open, the 5-minute bar, and the market close. More often than not, we're seeing the market close right where it opened, unless it's a trend day, of course, right? So if you don't have a catalyst-driven trend day, typically the market just reverts back to right where it opened at. And what does that do? It causes the most amount of options to expire worthless, essentially, right? So the VIX is being suppressed. Again, I don't think it's wise to sell too much premium right here because, again, if we do get a pop in the VIX, usually it'll be catalyst-driven. Could be the debt ceiling, could be another small bank collapse, perhaps. But right now, 20 is a key area I'm looking at. If we break above that and hold above that, I see a push perhaps to 25 to 35. But again, that would require some cataclysmic event like a larger bank collapse perhaps, or the debt ceiling being pushed out, for example.
Yeah, so I have to agree, but the one thing, volatility inevitably will return when the market starts to go through some sort of a correction. I still think that will be ultimately what will prevail. While the 20 level to me is important, I really think at this stage, the real risk point where the market is really worried about something, I think is even higher, where we would need to see a break above like the 25 level that really ensues some sort of panic. I think a return back to the 2022 vol, which I think is an important level, isn't necessarily going to be driven by fear or panic buying of options. But we'll see how it develops here. Nonetheless, let's move on to page 9, where we have the dollar index. Eric, what are you thinking here on the dollar?
No real change in my view from previous weeks. We're consolidating, not crashing. There is no new trend signal until we get a daily close below 100 or over 105 on the Dixie. We're right smack dab in the middle of a nice healthy consolidation.
Yeah, Eric. So the 101 support line I've drawn on here on the chart, and we continue to see that support line hold very well. That corresponds with the 110 level on the euro. I continue to think the euro will be the key in order to make a real bear case for the dollar breaking down. Really will rely on making a bull case that the euro is somehow going to be able to beat these key overhead resistance level between 110 to 112. I am just not in that bull camp for the euro or the bear camp for the dollar. I think trade range bound currency is much more likely. If the support line level holds here, I think the dollar trading back to 104 to 105 on the dollar index is far more likely here, and we'll be looking to see whether these upticks here actually follow through at some point.
Now on page 10 here, we have the chart of the gold futures. What are you guys thinking here?
Well, as a gold bull with a sizable long position on, I'm delighted that the market has not moved higher since last week. In my opinion, we need to take our time working through all-time high resistance before a real breakout with gusto can start. So the best case, in my opinion, is if we can keep this consolidation between 2000 and 2064 going all the way, let's say, into July, and then break to new all-time highs. That would be my ideal case. I was hoping that before that happened, we'd get a correction down, so I'd have a chance to add to my longs at lower prices. So far, no luck on that, but I am actually quite pleased that we're not seeing the breakout that looked like it was starting to happen last week.
Eric, looking at this gold chart, to me, I'm starting to see a little bit of divergent momentum. And I continue to think that while gold has a very strong bull case going forward, I think that there's going to be a number of volatile events that will, check these rises, and we could see some deeper reversions. I actually suspect that at some stage we could see pullbacks to 1900 or more, and especially if the dollar is strengthening in that cycle, we'll see whether or not some sort of a broader macro risk-off cycle leads to a little bit of distribution on gold. I don't think we're going to see anything crazy like it returning back to last year's lows, but this rally being checked is something I think is an immediate risk, but I would view almost every pullback in gold here to be a buy on dip. Now, the last chart I wanted to just touch on page 11 is the copper futures chart, and copper has been put in its high in January, and it's been more or less stuck in a distributive little trade range where all rallies were failing and getting heavy. But what we got in the overnight session was a considerable breakdown below the March and April lows. And the question now is Dr. Copper suggesting something in terms of whether the economic slowdown has actually come about? Are we finally going to see some sort of a recession kick in? And is copper signaling that? One day doesn't make a new trend. This could obviously reverse back to $4 in the coming week and it'd be a nothing burger. But a breakdown like this is worth paying attention. I'm going to be watching this copper chart going into next week.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.